Imagine this. A bank approves a loan for a customer at 10:15 a.m. By 10:16 a.m., the customer walks out richer. But no cash is printed. No truck leaves amid. No vault opens. Yet, brand new money has just entered the economy, created from nothing more than a signature. Why does this matter today? Because that quiet moment happens millions of times a day across the world. And every time it does, your savings, your loans, your cost of living shift by a fraction you never agreed to. This is the part of the financial system that is so ordinary we stop noticing it. But once you see it, you cannot unsee it. Let's slow down the scene. A customer needs money to buy a car. They walk into a bank and request a loan. We like to imagine the bank hands them someone else's deposits, like passing around a big pot of existing cash. That sounds reasonable, safe, almost communal. But that is not what happens. The bank checks the customer's credit and income. If approved, the bank simply types a number into the customer's account. 15 lakh, 30 lakh, 1 crore, whatever the loan is. Those numbers did not previously exist. They were not moved from anywhere. They were not saved by someone else first. They appear as digits, backed by the promise that the customer will repay. This is the quiet magic trick. The bank creates a deposit by creating a loan. In accounting language, the loan becomes the bank's asset and the deposit becomes its liability. 2 entries, 1 moment, new money. If this sounds too simple, that is the uncomfortable part, because simplicity does not mean small. In many countries, more than 80% of the money supply is not physical cash. It is digital credit created by commercial banks issuing loans. Most of the money flowing in your economy was never printed. It was tapped. Now here is where it gets stranger. When you repay your loan, the money disappears. The digits you once had get erased from the system. Interest stays with the bank, but the principal goes back to where it came from, nowhere. Money appears when we borrow, vanishes when we pay back. Creation and destruction tied to debt. So what pushes banks to keep creating money? Incentives. More loans mean more interest. More interest means more revenue. And when everyone is borrowing because money feels cheap, banks create more of it. This pushes prices up, encourages more borrowing, and the cycle spins until it slows or bursts. Remember the housing bubble. Loans created money. Money inflated prices. Higher prices justified even bigger loans. And when trust finally cracked, the system froze. It was not a printing press that caused the crisis. It was a spreadsheet. Now imagine the irony. Most of us work for money that originally came into existence because someone else went into debt. Your salary, your rent, your grocery bill, ripples of loans issued years ago. Debt is not the opposite of money. Debt is the source of money. This brings us to the uncomfortable question. If banks can create money so easily, where does value come from? From productivity, from trust, from belief that the numbers in our accounts will buy us something tomorrow. We keep debating government spending, national debt, budget deficits, but barely talk about the private money creation happening every minute, shaping the prices we pay and the futures we expect. So here is the final thought. If money can be created at a keystroke and destroyed with a repayment, and if the supply of that money quietly affects everything, from house prices to inflation to opportunity, then who really controls the rhythm of our economy? And what happens if one day we all stop borrowing?